Peter Crawford, let's talk bonds. Do investors really know what they're getting when they're buying bonds?
The fixed income markets have traditionally been very opaque, very mysterious for investors, unlike the equity markets. What we found when we talked to our clients, investors in general, is that they really don't understand entirely about how the markets work. And in particular, they don't understand about pricing. Many investors say pricing is certainly very, very important to them, but more than half of them have no idea actually what they're paying for their individual bonds that they're buying.
So most likely they're overpaying for their bonds. How much are they overpaying by?
It varies. So if at Schwab, for example, you buy a $1,000 bond, you'll pay a dollar markup. At a wirehouse firm or a full commission firm, you could pay as much as 2 or 3 percentage points, $20 or $30 on a $1,000 bond.
People have been talking forever about getting a centralized exchange for bonds. It never really comes to fruition. What kind of an alternative does Schwab have?
Well, Schwab's created a proprietary platform which we call Schwab Bond Source. You can think of this a little bit as the sort of like the Amazon of the fixed income markets. What we actually do is we actually connect to over 200 dealers around the country, 200 bond dealers around the country, which means that when you buy an individual bond, you're often getting multiple quotes for that bond. What that means is those dealers are competing for our client's business. If you're getting 8 or 9 quotes for an individual bond, it ensures that you're getting a great price on that bond, and then we apply only a dollar markup to that price.
Mostly it's high net worth investors who buy individual bonds. So for the rest of us, for retail investors, is it better just to stick with no-load mutual bond funds or ETFs? Is that the better alternative for the 99%, if you will?
What we would say is certainly if you have $10 or $15 or $20,000 to invest in fixed income, a mutual fund or an ETF is going to be a better way to go to ensure that you get that diversification. But for clients who want to invest $100,000, $150,000 in the bond market, many of them prefer to buy individual bonds. They want to know that if they hold that bond to maturity, they will get their money back. They don't have to be subject to somebody else's decisions about when to sell those bonds.